Welcome back to Spicy Takes and Tax Breaks, where we mix strategy, sarcasm, and all the things the IRS really wishes I would stop saying out loud to you all. But here I am, Aubree Denekamp. I am your tax strategist, numbers therapist, and the woman who is here to remind you that all of your lifestyle choices have tax consequences. It's really up to you whether those work for you or against you. And that's the part that I love the most. So today's episode is dropping right before Christmas. Hope everyone is getting ready for the holiday season, which means you're probably doing one of these three things. You're either panic shopping, emotionally spending, or you're avoiding it altogether and telling yourself, it's fine. I'll deal with it in January or April or whenever extension, depending on what you file at, is. So I need you to hear me when I say this. January is already too late for most people to do the things that are actually going to matter or make an impact in their business or their tax situation. Most of these things are not going to be done once January comes. It's going to be too late for most of the things that actually are going to matter or impact that situation. Most expensive Christmas gift that you're probably going to be giving this year, whether you realize it or not, isn't the one that's going to be under your tree. It's not the one that your child is asking for, regardless of what that is. It's the one that you're quietly handing to the IRS without even realizing it's happening most of the time. So let's talk about that. And more importantly, let's talk about how to make sure that you're not going to do this, whether we're ending out 25 or even better, moving into 26. So how do we do that? The part that no one is really explaining to you probably, and it's the reason December quietly is costing people thousands and thousands of dollars. December is so emotional for most people. And honestly, emotions are very expensive. I don't know about you, but I emotionally shop, I emotionally spend, I emotionally avoid things. Several different ways to do so, but either way, expensive. And this is the month where people are doing several different things. They're buying things without thinking. They are swiping a credit card. They convince themselves that everything is probably deductible in their business and they're going to show it to their CPA when they go in the spring. And either way, it's probably deductible. Maybe they ghost their payroll. They forget that retirement deadlines even exist and accidentally maybe blow up tax strategies that were actually about to work for them but missed it by just a mark. So how do we not do that? Before you beat yourself up, this isn't really usually even a discipline issue. It's something that starts and something I advocate strongly for in the education currently for children, but it's exactly that. It's an education gap. No one ever taught you these things in school, I'm assuming. They never told you that timing matters more than the effort or the expenses that you're putting into things. The IRS really doesn't care that it's Christmas. Maybe the girl math does, just like it does me, tell you that it's basically free because you get one free after buying two. Duh, free. But they don't really care that you're overwhelmed either. They don't care that you meant well, that your child is screaming. What they do care about are receipts, dates, amounts, structure, period. I mean, it's that. Every December, I watch smart people hand the IRS so many thousands of dollars that are unnecessary. Not because they're careless, not because they didn't think they were coming up with some sort of a plan in a sense, but they waited too long to act on anything. They didn't put a plan in place or have that plan checked. And we're not doing that this year. We're stopping that. I hope everyone is listening when I say that. Every single person, whether you own a business or a solopreneur, an entrepreneur, you have a W-2 income, whatever that looks like, this is something you can do. So one of the things I want to clear up right now, because this is where most people either freeze, go way across the line that you don't actually want to cross in a legal sense, or they say, hey, I want to be safe and it's fine. I'm making money, so I'm going to pay the IRS. But just because money leaves your account does not mean it helps you on your taxes, whether that is paying yourself or paying a bill. I want this to be tattooed permanently into your brain because I hear it constantly. But Aubree, I paid for it in December. But Aubree, it came out of my business account. But Aubree, I put in a journal entry reimbursing myself for it. But Aubree, my accountant said that it might count if I brought it to a CPA and said how we're going to put this out. At the end of the day, it is a gamble, and the IRS is typically undefeated if they ever come knocking. Do they come knocking? That is a gamble, part of the gamble. But when they do, it's not worth it. And this is where people often do get stuck. They either go so conservative that they leave so much money on the table, or so aggressively that they're flirting with potential fraud. And there is such a middle ground, and it's so legal, and it's something that most people can utilize. But you have to understand what actually matters, and it's not a swipe that matters. It's how you're swiping. It's how your business is structured, whether you are on a crash or accrual method, whether payroll was actually run, whether you as the owner are on payroll or are as just a 1099 basically through your company. How the expense is categorized. Is it meals or is it promotional marketing? Is it gifts that aren't really gifts? What does that look like? And all of those are weighted differently, not dollar for dollar on how you are actually getting that benefit from you when it's time to file for the IRS. And this is when everything happens. So let me give you a couple of real world, like, oh shit examples that I hear year after year without fail. So one of the biggest ones, and it's something that hurts because I see it truly every year from several clients, whether it is at the end of the year or a new client coming into me at the beginning of the year. But a client signs paperwork for a vehicle, let's call it December 29th, or where we're at even now, December 22nd. It's financed, minimal cash down, maybe no cash down even, and they're feeling good because, it's done before the end of the year. I can write it off. I hear about all these great special depreciation things, Section 179. I can blow all of this money in the next year and basically write it off. It's great. Except the car actually never left the lot. They did all the right things, but it wasn't placed in service. It wasn't used in the business in any capacity during the year. It wasn't documented. And here's where it really starts to unravel for most people. The entity structure could have been lined up incorrectly. The business use was 0% established because it never came off the lot. There was no mileage, there was no usage. It couldn't even be tracked if they wanted. And deduction is assumed, it's not planned, it's not going to do anything for you. So when it's time to file the return, whether you're told it right now or not, I have a lot of people who are like, yeah, I've been deducting X, Y, and Z year after year. It's great. I don't know why you're telling me something different. And then we really zone in and actually look at what their tax return is reflecting versus what their QuickBooks account might be reflecting. And they don't match. A lot of times those things are just moved over into a distribution and not kept actually as a business expense because that is legally how it needs to be recorded. And no one is telling you this. So year after year, you're racking up incorrect expenses. It makes no sense. So when you get to that return, there is zero depreciation. There's no Section 179 in this example. There's no magic write-off of this new vehicle you bought before year end. But the payment, it absolutely is still on you. The interest, the vehicle, everything that comes entailed, that is still on you fully. And yes, you can deduct that into the next year, but not in the way that it was intended, the whole purpose of you purchasing this asset. And that part is very real. You're locked into this vehicle now. The tax savings, not counted for. It's not strategy at this point. You're just buying a write-off that never turned on. And the IRS doesn't care. They don't care about any of that. The asset was never placed in service. And that is super important here. And something that I think a lot of people are misled on when they're watching online influencers talk about how to buy a G-Wagon or whatever else. Yes, I absolutely recommend doing the same thing, but do it right. Don't do it incorrectly. It's expensive optimism at best, if that's how you're doing it. Another common one that I get pretty much almost a year is, at least, maybe even every month, if we're not even talking in a tax sense, but someone swipes something they put on their business card, whether that is a checking account, debit card, or credit card, and they think, hey, it's fine, it's a business deduction, and if it's not, I'll sort it out later. But this ends up costing so much more money. I get it. Bookkeeping sounds annoying and no one wants it, but it takes so much more time and effort to reclassify, and there's so much that's lost in the shuffle. There's usually transfer, income, revenue, owner distribution problems that come, payroll imbalances. Your salary projections are wrong if you are already incorporated in some sense. And yes, a lot of times this stuff is recharacterized on the return, meaning you have to amend, or you're having a shit ton of penalties and interest, which no one wants that either. So I guess to wrap that up, using a business account doesn't magically turn something into a deduction. It is still categorized as a personal expense, even if it's ran through your business. All you're doing is setting yourself up to pierce that corporate veil, which means you're opening all the protection, your liability protection for your limited liability company was supposed to give you is kind of wiped out there if you're ever sued. So something to look back at our last episode, we kind of dig into that deeper, but it just creates so much more cleanup work that's not necessary. so many missed opportunities for different deductions that could have counted, and also those red flags for audits we really do want to avoid. And I know a lot of you are listening and saying, great, you're just telling us what not to do and how terrible we are, and guess what, auditors might be coming for you. But if you're listening while driving, please do not accidentally rear end the car in front of you. A scenario that can often be corrected, and most of these can, regardless of where you're sitting. So obviously contact me, contact one of my team members, contact your team members if you have a great CPA on staff or strategist. But you can actually be retroactively fixing a lot of these. So say you are an S Corp and you forgot to file a payroll for yourself for the year. You're thinking about that now. Absolutely, it's not even something that needs to be amended. It's just something that needs to be calculated and put into place. But let's say that you actually did have an ordinary or business expense in any fashion, in any category that it could be put. It wasn't categorized correctly. Payroll hadn't been run yet. Maybe you took a solo 401k, you maxed it out, but that wasn't put onto your W-2. And in many cases, that can actually be reclassified properly before end of year or after end of year is already closed. So don't be panicked. Mistakes happen. They can be fixed. Like I always say to my clients, it's always better to let us fix it before the IRS comes knocking. Penalties and everything is so much better that way. We can always do a lot of things. If you're in this place, it's not end of year yet. We want to make sure you align your payroll retroactively. If you haven't already been paying yourself for this year, if you're an S Corp or a C Corp, we want to take a look at bonus structures, where you're out for expenses. Can you prepay anything? And is there anything that you can really still get a benefit for legally? This is why strategy matters more than the filing in most cases, depending on what threshold you're at. But most uh-ohs aren't because someone didn't think that they were doing something wrong, or they thought they were skirting a system or doing something terrible. It's either you're overpaying and the crime is against yourself, or that the pieces just didn't add up and you had bad advice, or you thought you could do X, Y, and Z and you couldn't. So reminder, buying something or investing somewhere without understanding how it's actually hitting your return is like buying lingerie without knowing if it's actually going to fit. It's amazing in theory, but it can be so painful and embarrassing when it actually comes to practice. And I promise you, the goal here is not fear, it is clarity. I want everyone to be able to utilize all these things. They are out here for every single person, whatever structure you're in or whatever income threshold you're at. So, because once you understand how to actually use this for yourself, you can do it how everyone else is. You can stop guessing, and you can stop accidentally tipping the IRS for something you never wanted to do in the first place, which is work to have to get the revenue or the income coming in. It's great coming in, but no one wants to have to do that typically to begin with, to now have to pay someone else for the tax. So let's pull back the curtain for a second on how to do this before the end of the year. People who are not panicking in April, they're not smarter than you, they're not luckier than you, they might have more money than you, probably do, but they're definitely not working harder to get there. They're just being more intentional with the money they're using, but they're also being more intentional about how they're recording all the money coming in. So just as they're ending out the month right now, they're probably closing out their books. They're not making it a perfect clean bow tie for the tax filer, but what they're doing is they're getting it clean enough to trust the numbers that are in those reports. They're being able to get a financial picture that is painted and they believe in it. They can tell you what you should be paying yourself, what your distribution should be, what your payback to owner contribution should be, what you should be paying your contribution accounts for retirement. Should you be funding an IRA or a solo 401k? All of these things come from that initial basic report, which is the fun thing called bookkeeping. So after that, they're typically running those projections, making sure there's no surprises waiting for them later, because a lot of times you can mitigate that before closing the year. Making payroll decisions on purpose, not out of panic. This could be done. I know a lot of people who are looking at late elections right now, end of year salary adjustments, cutting bonuses, making sure they're funding those retirement accounts, like I said, in the right way, not guessing, not overdoing it if it's not a benefit and cash flow's not there, but also not paying the IRS when you don't have to. Prepaying any expenses you can, purchasing new equipment that is actually needed or going to optimize your tax picture, finalizing any updates to accountable plans, owner reimbursements, and actually locking in those deductions that are going to hold up and not even get you in an audit list to begin with. And just as importantly, choosing what not to touch is a great thing here. They're not trying to do everything. They're not trying to buy everything and implement 8,000 different plans. They're sticking to core things that work for the picture they're in. They're doing those few things that move the needle, that move those tax brackets, shift the income in a way that need to. And the wealthy people are not winging December. They are closing the year in the same way they're building wealth, which is on purpose. It's very intentional, and it's meant to continue to be sustainable year after year, but only grow. If this made you uncomfortable in any way, that's great. This means you're paying attention, and usually at that moment, awareness kicks in and hopefully growth at some point. And yes, awareness can feel so expensive and so unnecessary at times, but ignorance, that is always so much more costly, whether you believe it or not. So spend these next few weeks closing out the year right. Let's enjoy the holidays. I hope you are having so much time with your family, the people you love, drinking every single amount of wine and damn good cookies you can find. So remember though, just do not accidentally tip the IRS on your way out. Let's end this year right. Again, this is Spicy Takes and Tax Breaks. I'm Aubree Denekamp, and I'll see you next week as we close out the year, talking about how to start 2026 out with a bang. Looking forward to it.